Hello, everyone, and welcome to another Wall Street from Main Street podcast. Today we'll be featuring RC Peck from Fearless Wealth. RC, welcome to our show.
Thanks for having me.
Oh, you're welcome. So, first off, why don't you tell everyone about yourself? Right now, you are new to this show.
Let's see, about myself. The reason I got into this business of helping people protect and grow money is because my parents had their life savings embezzled from them when I was in high school. And, in high school you don't really know how things work. I didn't really think my parents were any smarter or less smart than anyone else. But what I realized in looking back was my parents' strategy was I trust and like my broker. Because they did trust and like their broker, except that he stole their money and everyone else's money at his business. So that really was kind of the genesis of why I got into this. Actually, I wanted to be a professional soccer player, but that didn't work out. I'm pretty passionate about this. I believe that how we behave, understanding how we behave, has more to do with how much we're going to make or lose with our wealth than anyone or anything else. And so I take that approach of understanding how we behave, and then I add into it technical and fundamental information to kind of build, the foundation of the approach I take to protecting and growing wealth.
All right, that sounds great. One thing I wanted to get into is, one thing I was told about you is that you know a lot about gold and silver. Recently, it's been had a big takedown in February, and I would say it's in a cyclical bear market, in a secular bull market. And right now, we're just in the middle of the bear market. When it's going to resume the bull market, I think anyone's guess is as good as any. What's your view on what's happened lately in the gold and silver market? Where do you see it going in the short and the long term?
Well, the short run's the most difficult to say what it's going to do. The answer is I don't know. What I will say is the world is moving towards gold. I'll talk about gold just because, we can talk about silver too, but silver's kind of, it will do what gold does, but to a much larger degree. So if gold's going to go up 100%, silver will probably go up 200%. If gold falls 30%, silver will probably fall 60%. So it's almost a leveraged play on gold. But the world is heading towards gold, is moving towards gold. Central banks last year were net buyers of gold, which was the first time they've done that in 50 years. So, there's kind of this who's buying gold and the demand of gold, and then kind of on the other side of the conversation is the actual price of gold. And there are actually two different types of gold. There's the gold traded on the futures exchange, and then there's the gold that people buy and possess or keep in their possession. And it's kind of they're two different products. So long term, as I said, the world is moving more and more towards gold. We are in a 18 or 19 month correction. Humans don't like correction, especially if they bought at the top of that correction. But the fundamentals that are driving the price of gold up over the last 12 or 13 years not only have not gotten any worse or not stayed the same, but they've in fact gotten much, much better. And it is upsetting right now that the feedback loop on price moving up with fundamentals getting better is not happening right now. But just because it's not happening doesn't mean it's not going to happen. And I agree that we're in I'll just call it a correction. We're in a correction period, which in hindsight, or when we look back, people who have continued to collect their gold and silver each month will appreciate the longer it is so they can get more ounces in before it moves up.
Yeah, I definitely agree that we're in a correction, and it is frustrating about the fundamentals and then, the price going down. But another thing is what you can tell to support your statement that we're moving more towards gold and silver is just if you buy a real bullion product, the premiums are going up. They're not going down. A lot of people even claim, like, it seems like on the exchange, silver is at 27, but where can you buy silver for $27 an ounce?
Yeah, I mean, a lot of the silver products stop falling when silver falls below about $29. Like, it doesn't follow the paper silver price down, which, happened in 2008. It's happening again today. But again, it's really, I mean, it's even past frustrating. It's angering. There's despair. There's confusion. There's maybe I'm wrong. Maybe everyone is wrong who's in this. And this is in part and parcel why most people don't actually ever grow and protect their wealth. And it's because we really work against us. Like you, me, other earthlings and humans, we work against what's best for our money. And this is a very good example of where there are fewer and fewer people saying this must not be working, because it seems like even when we came into this move, there still weren't that many people or weak hands holding it, but there were. So, maybe we're done with it and gold hit 1539 last week and that's the bottom and we won't see that low ever again in our lifetimes. Or maybe it'll go down for one more push. I don't really know. And I don't want to sound flippant, but it doesn't really matter. Because what's driving this metal is increasing. And we don't live in a linear world, meaning if you push, 1 foot against this, you get 1 foot more of price increase. That's how humans want it to be, right? Information in, information out in a very linear pattern. And with money printing increasing in Japan and soon in Europe, we want that experience of when this goes down, that goes up. And it's really frustrating for us to realize that that's actually not how things work.
Yeah. Speaking of behavioral investing, right now the Fed minutes, they claim that they have a clear exit strategy for the end of the year. Do you see any possibility of an exit strategy?
Are they talking about exiting their jobs? that must be what they're talking about. They're exiting their jobs to go work on K Street at $1 million a year. So, I don't know how they could. I have a personal belief that they float out these statements. They float statements out there to see how their words affect the market. Because their words do carry more weight than other people. So it would be smart for them to say, hey, let's float this idea out there that we're going to do this, and let's just see how it happens. Let's see how it hits the market. I don't know. It's hard to see a way where after printing $3 trillion in the U.S., Japan's going to print a couple trillion over the next 2 years. Europe's printed a couple trillion. You got the UK printing. Let's just take the U.S. They've printed about $3 trillion. The Obama administration has gone into deficit, increased our deficit spending or our debt about $4 trillion. So just those two numbers is about $7 trillion over the last 4 years. And what did we get? We get about a 1.3% GDP growth rate in our country. Like, that's what $7, $8, $9 trillion gets you these days, is a 1.3 GDP growth rate. So that's not that good. Now, it's better than negative, but if you consider that all that money's been printed, all that deficit spending has happened, and that's all we've gotten, it doesn't seem like they're actually able to take their foot off the pedal until something drastically changes, and I don't see that drasticness happening anytime soon.
Well, yeah, I definitely agree. I would say at minimum, who's going to fund the government? That's, of course our media will never ask any of these type of questions, but I don't see any type of exit strategy because China wants to diversify out of the U.S. dollar. They're making trade deals, not needing U.S. dollars anymore with Russia and Brazil and others, and I don't see any other type of country, willing to buy U.S. debt. So I think at a minimum, they're going to have to at least monetize the treasury.
Yeah, I mean, Japan will probably implode, and when it does, the Japanese will probably buy U.S. debt, and we'll probably see the yield on the 10-year go possibly negative. I mean, I didn't look today, but maybe it's 1.75%. But if the Japanese wake up and go, wait a second, 6 months ago, I had this much buying power, and today it's dropped by 25%. Okay, that can't go on too long until the Japanese wake up and go, I need to move my money other places. And one of those places will be U.S. debt. But, I don't know what the end game is. The way I kind of think about this is the more complacent people get, the worse it's going to be, because it doesn't seem like there's been a big behavior shift in how people behave since the 50% drop in 2000 and the 58% drop in 2008 in the stock market. The behavior changes aren't really showing up that drastically or that much, which means, the group or the masses are going to have to touch the hot stove again before they actually start to change how they behave. And it doesn't seem like that's happened yet.
Yeah, I definitely agree. And speaking of exiting their jobs, we do know Bernanke's resigning in 2004. The last time a Fed chairman resigned was Greenspan in 2006, right before the bubble, so that might be a indicator. I want to switch topics to the stock market. Right now it's at its all-time high, yet you're seeing personal incomes decline. You're seeing consumers going more into debt. How can the stock market, well, I have a personal theory on this about they're bidding up assets, but how can the stock market rise so much and the economy just deteriorate it? And do you see the stock market continuing to rise?
Over the short run, I see the stock market continuing to go up. Now, I don't want to confuse that with what I think should happen, but you're asking me what I think will happen. And what I think will happen is the stock market will continue to go up. Let's just look at the situation here. So, and let's just talk about the United States. 320 million people. The bottom 95% of that 320 million people are for sure getting poorer. They're getting poorer each year. There's inflation. Their wages are deflating. Their houses have gone down in value. You say, no, housing is bottom. Yes, it has, but they've already lost their credit or been kicked out or been foreclosed on, so they can't even participate in this new round. So for the bottom 95%, for those people's economy, and maybe I'm even being too aggressive, maybe it's the bottom 97%, their economies are getting worse, and they will continue to get worse probably over the next decade until we're out of this secular long-term bear market. But for the top 2 or 3%, their economy is getting better. Now, I live in Silicon Valley, and if you think for a living, your wages at a minimum go up 5% a year, at a minimum. And that's if you're like a C-plus player. And they usually go up more. So the economy for people in Silicon Valley, or for people who are paid to think or solve problems with their brain, their economy is going up. And those people are putting their money in the stock market. They see their houses going up in value again after 6 years. And they've noticed, they're kind of seeing this, they're looking around and going, okay, money printing, okay, Bernanke has zero interest rate policy, okay, I'm not going to put my money in bonds. Commodities, which I don't consider gold and silver a commodity, commodities haven't gone anywhere, so there's another asset class gone. People don't usually trade in currencies, so no one invests in that asset class. So the only asset class that's left is the stock market. And so people are putting their money into the stock market, not because it's of great value or because they think profits are going to the sky, but because they actually don't know any better or don't know that there's any other choices. And that, John, I think it will end in tears for a lot of people, not the bottom 50%. Poor people will stay poor. The middle class will get absolutely slammed. They will get, they already are, but it will worsen. And what's funny is the middle class often vote for Democrats thinking, you will help me. But the lie is that they're actually getting poorer. So, there's different economies. Some economies are doing better, some economies are doing worse, but there will be a point where the markets have a reckoning, where they have to correct, where they will find their true value. And right now, the price mechanism, the price discovery mechanism of the stock market is broken because of the zero interest rate policies and because these major central banks of the world, the European Central Bank, the UK, the US, Japan, and China, but China does it slightly differently, are saying all we can do is print more money. So short term, we're all winners, we're all beautiful, we're all tall and smart, and eventually it will be revealed that behavior hasn't changed, and we will revert back to people saying, I'm only going to pay $7, $8, or $9 for $1 of annual income.
All right. One of your themes is, and one thing you emphasize is behavioral investing. When looking at a sector or when to invest or when not to, I remember reading on your website, sometimes it's just better to be not invested at all. What key market behaviors or human behaviors do you look for? And do you use it as contrarian indicators?
Well, I designed 4 strategies in the 90s after my parents had their life savings embezzled from their financial advisor. And one of my strategies, it actually counts the market. And let me just describe what I mean by that. If you've ever played blackjack or know someone who has, you probably talked about counting the deck or knowing what the count is on the deck, which is the same as knowing what the probability is of winning or losing your hand. Well, I figured if a human brain could count a deck of cards up to 4 decks of cards, I figured a software program could count 500 stocks. So one of my strategies is to look at the probability of the market going up or the market going down. And this is not a probability indicator that changes every day or every week or every month or even every quarter. It changes every couple of years. And the last time it had a signal alert was January of last year, and that took it into green light mode. So, the market's going up, whether it should go up or not, it is. But that indicator, that strategy is not so much behavior until it comes to the point in time where that strategy tells you to go to cash or get out of the market. Then a lot of it has to do with behavior, because I don't know about you, John, but knowing what to do has almost never helped me. I meet lots of people who know they should not, eat as much as they do or drink as much as they do, or they know they should buy something with a stop loss, but that knowledge doesn't necessarily help them or has ever helped them. But it's kind of the experience-based knowledge, understanding how you're going to work against yourself, that helps people grow their money. And so that is one of the reasons why I focus a lot on that.
All right, that's actually interesting. I always say don't let your emotions get involved in investing, because those are your most deadliest enemies, I think. One other thing you're famous for is technicals. I know a lot of people who don't really bother with technicals. They're more fundamental guys. They like fundamentals, or they just look at trends or averages and like historical averages. Mm-hmm. Why should someone get into technicals? What are the advantages of knowing them?
Well, there's always advantages and disadvantages with any approach. I discovered technicals in high school, and I didn't know them as anything else other than price charts. And I went to high school in the 80s. So what I saw was, I used to call them treasure maps. And I won't even get into technical indicators. Let me just stick with the price chart. And when I looked at them, and I've spent tens and tens and tens of thousands of hours in my life looking at price charts and spending time and looking, different frequencies. And one thing I noticed is when something's going up, it usually goes up for a while. And when something goes sideways, it usually goes sideways for a while. And I'm not trying to oversimplify things or get all Yoda on you, but humans love absolutely love. Humans have a deep desire to create complexity and complication in their life. And one of the most popular places humans want to create complexity is in the area of investing. And so once I realized that the human brain is designed this way, and I've been looking at these price charts, or what I call these treasure maps, for, at this point, 5 or 10 years, I noticed, wow, I'm really wanting to make things difficult. What if I just bought the thing that was going up and I assumed I was wrong? So I would get in saying, I'm going to lose money, not I'm probably going to lose money, or I hope I don't lose money, but I actually, and this is one of the things I teach, when someone is going to buy an individual stock, I teach them to say out loud what dollar amount they're going to lose. So, for example, Intel fell 35%, and I bought it December 6th. And I knew how much money I was going to lose if I was wrong. And literally, I would say out loud, and this may sound funny to you or the listeners, but I literally say, I'm going to lose $15,000 in Intel. So literally, my brain hears that. I hear it, and I know whether I can afford to lose $15,000 or not in my portfolio. But let's say I can, and let's say that's, for the sake of this example, that's 1% of my overall portfolio. So then I say, okay, I can survive a 1% loss in my portfolio. I will go lose $15,000 in Intel. No one does this. When someone buys Intel, they go in with hopes and dreams of fixing their past and making up for lost time and lost ground. They go, I'm going to buy Intel, and I'm going to put 40% of my money in it, and I hope this is the thing that changes everything in my life. And they're going in only looking in one direction, and that is, it's got to go up. It's got to go up. And as soon as it goes against them, the hope increases. They start, just taking that hopium, and there's no way they're going to make money. And I know that may sound negative to you, or may not, or to other people, but I found that you can literally take advantage of language and say out loud what you're going to lose, even if it's to yourself in a room by yourself. It changes how you behave. So that's why I like technicals, because it's so clean and it's so clear, and I know exactly when I'm wrong. And you don't know that with fundamentals.
All right, that actually makes sense, especially in the best example of you don't know that with fundamentals is, if you ask me, the resource sector. To me, it's ridiculously cheap. But to wrap things up, if our audience wants to find out more about you, how can they do so?
The easiest way to do that is to go to fearlesswealth.com, and on there, I've actually built a set of training. I've built a set of training videos that literally teach people the strategies that I use. So even if I never work with them or they work with me, I want them to at least, if nothing else, force them to think how they're thinking. But going to fearlesswealth.com can really start them on that.
All right. Thanks for having us on, and we look forward to having you on in the future.
Thanks so much.